March 17th, 1968, London. The gold market failed to open. For the first time since World War II, the London gold market, the center of global gold trading, remained closed. No explanation was given publicly. Trading was simply suspended, indefinitely. Behind closed doors, 8 central banks were in crisis. For 8 years, they had pooled thousands of tons of gold to defend a single price, $35 per ounce. The price fixed by Bretton Woods in 1944, the price that backed the entire international monetary system. By March 1968, they had lost 3,000 tons trying to hold that line, and the attack was accelerating. Gold was pouring out of central bank vaults at a rate no one could sustain. Private buyers around the world, individuals, speculators, foreign governments, were converting dollars into gold as fast as the pool could sell. The central banks faced a choice: double down and lose everything, or surrender and let gold float. They chose surrender. The London gold pool was dissolved. The market reopened 2 weeks later with a dual price system. Official gold remained $35 per ounce for central banks only. Private market gold would float. It was the beginning of the end for Bretton Woods. 3 years later, Nixon would close the gold window completely. But the real collapse started here, in London, March 1968, when 8 central banks admitted they couldn't control gold. This is the story of the 8-year war central banks fought against the free market, and why they lost 3,000 tons trying to defend a price that was already broken. Understanding the London gold pool is essential to understanding why Bretton Woods collapsed, why Nixon closed the gold window in 1971, and why governments fear gold to this day. It demonstrates a fundamental truth: central banks cannot suppress real assets indefinitely when the market knows they're overextended. The Bretton Woods system, created in 1944, pegged all currencies to the dollar at fixed exchange rates. The dollar itself was pegged to gold at $35 per ounce. Any foreign central bank holding dollars could redeem them for gold from the U.S. Treasury at that fixed rate. This created monetary stability but imposed discipline. If the United States printed too many dollars, foreign banks would demand gold. Reserves would deplete. By the late 1950s, the system was showing strain. U.S. gold reserves had peaked at over 20,000 metric tons in 1950. By 1960, they had fallen below 16,000 tons. Meanwhile, foreign dollar claims were growing. Europeans and Japanese were accumulating dollars through trade surpluses. Those dollars represented potential claims on U.S. gold. The math was becoming uncomfortable. If even a fraction of foreign dollar holders demanded gold simultaneously, the United States would face a run on its reserves. The system was built on confidence that such a run wouldn't happen. But confidence was eroding. The catalyst was France. President Charles de Gaulle distrusted American monetary policy and resented U.S. financial dominance. He saw Bretton Woods as a mechanism for American imperialism, the ability to print dollars and buy real European assets. In a famous 1965 press conference, de Gaulle explicitly called for a return to the gold standard and condemned the exorbitant privilege of dollar hegemony. France's strategy was deliberate and aggressive. Between 1965 and 1968, France converted over $750 million into gold, equivalent to about 600 tons. French naval vessels literally transported gold bars from New York to France. The physical movement of gold from Fort Knox to Paris vaults was symbolic, wealth flowing from the new empire to the old. But France wasn't alone in recognizing the problem. Germany accumulated massive dollar surpluses through exports and wanted gold. Britain needed dollars for domestic spending, but also wanted to preserve London's role in the gold market. Switzerland, traditionally neutral and conservative, began questioning dollar reliability. What made France different was de Gaulle's willingness to challenge the United States publicly and systematically. Other countries watched France's conversions carefully. Some quietly followed. Germany converted more cautiously, not wanting to antagonize the United States, which provided military protection against the Soviet Union. But the Deutsche Mark holders knew the same math France knew. Dollars were being created faster than the gold backing them. Anyone holding dollars was holding a claim that couldn't be fully honored if everyone presented claims simultaneously. But the real problem wasn't just official conversions. The private market was waking up. Gold had been fixed at $35 per ounce since 1934. $35 in 1934 bought far more than $35 in 1960. Inflation had eroded the dollar's purchasing power dramatically. Gold at $35 was artificially cheap. Anyone paying attention could see the arbitrage. If you could buy gold at $35 per ounce when it should be worth 50 or 60 or 70 based on inflation adjustment, you would, and people did. Private buyers began accumulating gold. Jewelry demand surged, industrial use increased. Speculators entered the market, all of them buying at $35, all of them draining gold from the system. The United States faced a dilemma: raise the official gold price to match reality, which would mean admitting the dollar had lost value and breaking the Bretton Woods peg, or defend $35 per ounce by selling gold to anyone who wanted it, which would deplete reserves. Neither option was acceptable politically. Raising the price meant devaluation and international humiliation. Defending the price meant eventual reserve exhaustion. The U.S. needed a third option: suppress private gold demand while maintaining the official price. Enter the London Gold Pool. Established in November 1961, the pool was a consortium of 8 central banks: the United States, United Kingdom, West Germany, France, Switzerland, Italy, Belgium, and the Netherlands. Together, they agreed to intervene in the London gold market to keep the private price at or near $35 per ounce. The mechanism was simple. When private demand pushed gold above $35, the pool would sell gold into the market. When demand subsided and price fell below $35, the pool would buy gold back. The goal was price stability. Keep gold at $35 in both official and private markets. Prevent arbitrage. Maintain confidence in the dollar. The United States provided 50% of the gold for pool operations. The other 7 countries split the remaining 50% according to agreed quotas. In theory, if the price held and demand stabilized, the pool would lose no gold on net. Sales would be offset by purchases. But theory and practice diverged dramatically. From 1961 to 1965, the pool worked reasonably well. Private demand was manageable. The pool sold gold when needed, bought back when possible, and maintained the price near $35. Losses were moderate. Confidence appeared intact. But 1965 changed everything. France began aggressive official conversions. Private demand accelerated as inflation became obvious. The Vietnam War escalated, requiring massive U.S. deficit spending. Great Society programs expanded. The money supply grew. Dollars flooded into foreign hands. All of those dollars represented potential claims on gold. By 1967, the pool was hemorrhaging gold. Sales far exceeded purchases. Net outflows reached massive proportions. In the first quarter of 1968 alone, the pool lost 1,400 tons of gold. At that rate, U.S. reserves and the pool's collective reserves would be exhausted within months. The crisis came to a head in March 1968. Demand for gold exploded globally. Buyers were no longer just sophisticated investors or foreign governments. Ordinary citizens in Europe were lining up to buy gold. Rumors spread that the pool was nearly exhausted. Banks reported surging gold purchases. Jewelry stores couldn't keep gold in stock. On March 14th, the pool sold 200 tons in a single day. This was more than many countries' entire annual gold production. The sales came from emergency shipments, gold flown from New York Federal Reserve vaults to London on military transport planes. The logistics were straining. Moving physical gold across the Atlantic takes time. Markets don't wait. March 15th, another 100 tons sold. The pool was selling at rates that would exhaust total U.S. reserves in weeks, not months. Central bank governors held emergency phone calls. The situation was unsustainable. If the London market opened Monday, March 18th, the pool would face unlimited buying. There wasn't enough gold to satisfy demand at $35 per ounce. The gold was draining so fast that central banks couldn't physically deliver it quickly enough. Vaults at the Bank of England were being emptied. Gold bars were being pulled from storage, assayed, packaged, and shipped continuously. Staff worked around the clock. Security was strained. The physical mechanics of moving hundreds of tons of gold were breaking down under the volume. The central banks called an emergency meeting. Representatives from the 8 pool members gathered in Washington. The discussion was blunt. Continuing the pool would exhaust everyone's reserves. The defense was unsustainable. They had two options: close the market temporarily to stop the bleeding or surrender entirely. They chose to close London temporarily while negotiating a new arrangement. On March 15, 1968, the London gold market was shut down. The Bank of England announced the closure without explanation. Trading suspended indefinitely. Behind the scenes, the 8 central banks negotiated furiously. France wanted to abandon the defense entirely and let gold float. The United States wanted to continue defending but needed burden sharing. Britain wanted to preserve London's role as the gold trading center. Switzerland wanted to protect its gold stocks. The compromise reached was the two-tier system. Official transactions between central banks would continue at $35 per ounce. Private market gold would float freely based on supply and demand. The pool would dissolve. No more intervention in private markets. Central banks would neither buy nor sell gold to private parties. The London market reopened on April 1, 1968. Gold immediately traded above $35. Within weeks, it reached $40. Eventually, it would reach hundreds. But the immediate impact was the abandonment of price control. The central banks had surrendered. Why did the pool fail? The fundamental problem was that $35 per ounce was too low given dollar creation. From 1934 to 1968, U.S. money supply expanded massively. World War II spending, post-war reconstruction, Korean War, Vietnam War, Great Society programs, all required deficit financing, all added dollars to the system. If the money supply triples but gold price stays constant, gold becomes undervalued. Smart money recognizes this. France under de Gaulle recognized it explicitly. Private investors recognized it gradually. By the mid-1960s, the arbitrage was obvious. Buy gold at $35, hold it, wait for the inevitable repricing. The pool tried to prevent that repricing by selling gold. But selling gold to maintain an artificially low price when demand is rising is a losing strategy. You're transferring real assets, gold, to private hands in exchange for depreciating paper, dollars. Every ounce sold strengthens the buyers and weakens the sellers. Central banks lost 3,000 tons fighting this reality. 3,000 tons transferred from official reserves to private hands at $35 per ounce. Those private buyers made fortunes when gold later floated to hundreds of dollars per ounce. The central banks locked in losses by selling low what they knew was undervalued. France understood this. That's why de Gaulle converted dollars to gold aggressively. He was extracting real value before the system broke. France accumulated gold while others defended the peg. By 1968, France held more gold relative to its economy than almost any other country. De Gaulle played the game correctly. The other pool members, particularly the United States and United Kingdom, played it incorrectly. They sold gold to defend a price that was unsustainable. They transferred wealth to private buyers who understood the game better. When the pool collapsed, the selling countries had less gold and the same amount of dollars. The buyers had more gold bought at artificially low prices. The lessons from the London gold pool apply directly to today. Governments and central banks still attempt to manage gold prices through various mechanisms: futures markets, leasing, official sales, forward contracts. The tools are different. The goal is the same: suppress gold to maintain confidence in fiat currencies. These suppression efforts fail for the same reason the pool failed. If you sell real assets to defend an artificial price while creating unlimited paper claims, eventually the real assets deplete and the paper claims overwhelm the system. The mechanics visible in the pool's collapse, official gold draining to private buyers who understand the arbitrage, repeat today in different forms. The two-tier system lasted exactly 3 years. From April 1968 to August 1971, official gold traded at $35 between central banks, while private gold floated higher. This arrangement was supposed to preserve Bretton Woods while acknowledging market realities. In practice, it created an obvious arbitrage that governments tried to prevent through regulations and agreements. The logic was simple but flawed. If central banks could still convert dollars to gold at $35 officially, while private market gold traded at $40 or more, there was a clear 14% profit available. Buy official gold at $35, sell in private market at $40, pocket the difference. Regulations prohibited this arbitrage explicitly, but prohibition doesn't eliminate incentive. Countries holding large dollar reserves faced constant temptation. They could either keep holding depreciating dollars, convert them to official gold at $35 from the United States, or sell dollars in private markets for less. Each option had drawbacks, but converting to official gold while possible was the least bad choice. The problem? Everyone recognized this simultaneously. The gap between official and private prices created constant tension. As private gold rose to $45, then $50, the pressure on the official price became unbearable. Foreign central banks knew that if they hesitated, the U.S. might close the window entirely and leave them holding worthless dollars. The incentive was to convert quickly before others depleted the remaining gold. This created a first-mover advantage that guaranteed the system's collapse. By 1971, the remaining U.S. gold reserves were under pressure from multiple sources simultaneously. France continued converting. Germany accumulated massive dollar surpluses and wanted gold. Britain requested gold conversions. The $35 official price was fiction. Private gold traded at $40 or higher. The U.S. couldn't sustain conversions much longer. Nixon closed the gold window on August 15, 1971. He suspended convertibility temporarily, the same word the London Gold Pool used when closing the market in March 1968. Both temporary suspensions became permanent. The link between gold and official money was severed. But the critical damage happened earlier. The pool's collapse in March 1968 was the moment central banks admitted they couldn't control gold. The two-tier system from 1968 to 1971 was a managed retreat. Nixon's closure in 1971 was the final surrender. The war was lost in London. Nixon just signed the armistice. The pattern observable here, governments defending unsustainable pegs until reserves exhaust, then abandoning the peg and calling it temporary, mirrors what systems like the 7-stage collapse survival guide document. Artificial stability maintained through asset sales creates the conditions for inevitable collapse. Understanding which stage you're in matters more than predicting when it breaks. Today's parallels are striking. Central banks hold approximately 35,000 tons of gold officially. That sounds substantial until you consider the scale of fiat currency creation. Global money supply exceeds $100 trillion. If even a fraction of that sought gold conversion, reserves would exhaust quickly. The mechanisms preventing such conversion aren't physical anymore. They're regulatory and psychological. Citizens in most countries cannot demand gold from central banks. Currencies float against each other with no gold backing. The system works on pure confidence that governments won't print excessively. But governments do print excessively, always have, always will. The constraint that gold imposed is gone. The London Gold Pool was the last serious attempt to maintain even a partial gold link. After it failed, the constraints disappeared entirely. Money became purely political. The question isn't whether today's fiat system will face a crisis similar to 1968. It's when and what form the crisis takes. The fundamental dynamics haven't changed. Governments create currency faster than economic growth justifies. Real assets, gold, land, productive capacity, don't expand as fast as monetary claims on them. The gap widens. Eventually, holders of paper claims try to convert to real assets. The system can't deliver. In 1968, the mechanism was official gold conversions and private market purchases. Today, it might be different. Cryptocurrency adoption, flight to commodities, currency crises in emerging markets that spread, sovereign debt defaults. The trigger will be different. The underlying cause will be the same. Too much paper chasing too few real assets. The London Gold Pool shows what happens when central banks fight the market. They can delay the reckoning, they can suppress prices temporarily through coordinated intervention. But if the fundamentals are wrong, if currency creation exceeds real economic growth, the market eventually wins, always. The 3,000 tons lost fighting gold from 1961 to 1968 represented wealth transferred from governments to private buyers who understood the game. Those buyers acquired gold at $35 that would later trade at hundreds. The governments locked in losses selling low. The private sector locked in gains buying low. When the London Gold Pool closed in March 1968, there was no warning. Investors woke up, and the market was locked. No gold available, no conversion, done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse, before banks freeze, before governments confiscate, before inflation devours your savings, while you can still act. Access it at https://pay.hotmart.com/B1033628817E. This pattern repeats. Every time governments try to suppress real asset prices while creating unlimited paper, wealth transfers from public to private hands. The London gold pool is just the most documented example. The scale, 3,000 tons over 8 years from 8 countries, makes it impossible to ignore. For anyone today watching central bank gold sales or futures market interventions or regulatory restrictions on precious metals ownership, the pool provides the template. These are not random actions. They're coordinated attempts to manage perception and suppress alternative stores of value. They work temporarily, then they fail. The pool shows the endgame. France's strategy, convert paper to gold while you can, proved correct. The pool's strategy, sell gold to defend paper, proved disastrous. The lesson is clear, but few governments learn it. The political incentive is to defend the peg, maintain confidence, and hope the problem resolves. It never does. By March 1968, the pool had fought for 8 years and lost. The closure of the London market was admission of defeat. The two-tier system was a consolation prize. Nixon's 1971 closure was formality. The war ended when the pool dissolved. Understanding this timeline matters because it shows how collapses actually happen, not in a single moment, but in stages. The pool fought from 1961 to 1968. The two-tier system lasted 1968 to 1971. The full float began in 1971. Observers in 1961 might have thought the system was fine. Observers in 1965 might have thought the pool was winning. By 1968, the end was obvious. But it took 3 more years to formalize. Anyone watching today's monetary system should recognize the pattern. Central banks expanding balance sheets, gold prices managed through futures markets, regulations preventing private ownership or making it difficult, negative interest rates making currency holding costly. These are all defensive actions. The pool tried defensive actions. They failed. The outcome is predetermined by the fundamentals. If you create unlimited currency while real assets are limited, the currency eventually devalues against those assets. The only questions are timing and magnitude. The pool tried to prevent devaluation for 8 years. It cost 3,000 tons. Today's efforts will be equally futile and possibly more expensive. The gold pooled and lost from 1961 to 1968 went somewhere. It didn't vanish. Private buyers accumulated it. Those buyers made fortunes. The governments lost both the gold and the credibility. When the system finally broke in 1971, no one was surprised. The pool's collapse had already shown the ending. For anyone today deciding between holding currency or real assets, the pool provides historical guidance. The central banks fought for 8 years and lost 3,000 tons trying to make people believe gold wasn't worth more than $35. But people eventually stopped believing. The market won. The same fight is happening today in different forms. Governments need people to believe fiat currency holds value despite unlimited creation. They need people to believe gold is a barbarous relic with no monetary role. They need confidence in the system to persist despite the fundamentals deteriorating. The pool shows what happens when that confidence breaks. The system doesn't collapse instantly. It collapses in stages. First, the private market separates from official prices. Then official prices become unsustainable. Then the link is cut entirely. Each stage is called temporary. Each becomes permanent. March 17, 1968 was the day the official narrative broke. The London gold market didn't open. The pool had run out of gold to sell. 8 central banks admitted defeat. The market had won. Gold would trade freely. The only question was how long governments would maintain the fiction of official prices. 3 years later, Nixon answered that question. Not long, the pool's collapse made his decision inevitable. You can't hold $35 per ounce when the market trades at 40 and rising. You can't defend a peg when your reserves are depleting. You can't maintain confidence when the arbitrage is obvious to everyone. The London gold pool was the last honest attempt to maintain a gold link. After it failed, governments stopped trying to back currency with anything real. Money became pure fiat. The pool's collapse was the moment that became inevitable. Nixon just made it official. Those who understand this history see today's monetary system clearly. Those who don't keep trusting the same promises that failed in 1968 and 1971. The choice between understanding and ignorance has never been more consequential. This is Decoded Economics. Subscribe to see the future before it arrives.